What is the best performing asset in 2018? Well, let's take a look. You came here for the truth, so let me unveil that for you. Much to cover today, and I want to begin with the total return performance of major global financial assets January 2018. So it's a little early to tell thus far. We have the S&P 500, you can see it here, which I want to use as the benchmark. You've seen it increasing throughout 2018 and of course throughout 2017 as well. But this gives us a good idea as to where these other assets have come and gone. Look at the rise in some of these assets, and this is only 2018 at this time. You can see that even wheat has performed better. Other commodities such as oil, and then we look around the world, whether it's China, and you're seeing the UK and Greece and others. So we can see that there's a consistent trend here that there's enough money to be floating around to really push up any commodity or market. Look at this. Spanish bonds. That's one that I really wanted to highlight. Now, Spanish bonds, let's take an estimate here, probably approximately 5%, right? Spanish bonds, like many other countries in Europe, are simply one of the dominoes that will fall in the future. But they are still performing well in this case. Why? Because the ECB is there to backstop any problems. But if you look at Argentina goes out and sells a 100-year bond, even though they have defaulted several times over the last, even, let's say, 50 years. They continuously default. So investors know that they're never going to hold that to maturity, yet they sold an astronomical amount of these bonds. Century bonds. There's no way they'll ever pay back, but yet they're given an extremely high rate. The yield is great, so they figured, okay, let's get in. And that's what's really troubling about what's happening here, not just with Spanish bonds, but others as well. Think about this. You have a particular country, like let's say France or Germany, they own Spanish bonds, they own different countries' bonds, right? And they have an incentive to keep them alive. So they keep up buying their debt. The ECB goes around and buys the debt of those particular corporations in those countries. And they all have some stake in this. They all want to make sure that things stay afloat. So in effect, what happens in one country affects the other and is very direct. All of the dominoes will fall. It will have to happen. What order? I'm not sure. I can tell you though that Spain and Italy are two major factors. I wrote about that in my first book, in fact, and I again wrote about it in my second book. You can tell what's going to happen is very easy because you look at the amount of debt that they're carrying, and then you see, what happened in Greece, for example, and everyone thinks that the issue of Greece has been resolved, but absolutely it has not. Look, Greece right here. Now, you can fool people for a period of time, but it can't be done permanently. Eventually, everything reverts to the mean. Okay, now look at this. Math of loss. Missing the 10 worst days, far more important. So this is an interesting way to look at things. This is coming from Real Investment Advice. And what they talk about here is at the bottom, if you can read it, the $100,000 missing 10 best days, missing the 10 worst days, or invested in the index, basically buying and holding. And see what happens here. Since the financial crisis, things have really been interesting. So if you simply missed out on the 10 worst days since the financial crisis has happened, you would be accelerating off into new highs. And it just shows you how there are these strategies that people are told, buy and hold, buy and hold. But it's really not about that for the big investor. You as the individual, you're told that. I mean, you can't be a day trader. A lot of people can't. So what do? They just simply buy and hold. But that's not really the best strategy to do. And the markets that work upon all these computer algorithms, guess what? They're working on those strategies. And they are able to manipulate the system. And then you get stuck with dismal returns in the end. Because remember what's going to happen with the 10 worst days, right? You need to remember that you're going to be in the market on those 10 worst days. Hopefully you don't sell. Part of that, of course, is making sure that you're holding on the good days. And then, of course, when those really bad days do come, that you're not in the market at that time. But, of course, many people will be. And then they have trouble. This is what this chart is about. Have trouble basically keeping their capital consistently on an upward pattern. Now look at this. 1929, good example. I talk about this in my first book, actually. 29 years to get back to the same level it was at before. I don't know if they're factoring in inflation here, but it could be. 23 years in this case here. In this case, 16 years. So we're talking about the markets going to new highs. Oh, it's amazing, it's great, it's awesome. But many people are counting it from the absolute bottom. And I don't know, see, we're getting this number of 878 here, the S&P 500, perhaps because it's saying the real S&P 500 total return. Anyway, regardless, it was 666 if I'm not mistaken on the S&P 500. Doesn't matter. The point has been made that it takes long periods of time sometimes to recuperate. Sure, if you invested at the bottom and you have held on to the top and you're sold, you've already sold, you've realized your gains, you have done very well. But the average person, guess what? They ride the wave down. Maybe they pick up some pieces at the bottom and then ride the wave up. But look how long it takes in real terms to get back to where it was. Many people simply can't afford that. They have bills to pay. They have other things. I mean, they're probably on margin too, so they're going to be underwater. And of course, they like to double down as it happens. Cumulative bull versus bear market in terms of points. I thought this was really interesting, actually, when you can see, looking at it in terms of points here, the inflation adjusted S&P 500 index. Look, 1800, right? And then within a very, very short period of time. So it took, think about this, it took all these years to hit up 1800 points. But then in such a rapid clip, 972, half of it drops off in an instant. Same situation, 675 on the way up, 919 on the way down. Up now, 1415. And if you could see, look at this decline here. How long it was? Shorter, shorter. And that means that the drop is going to be so severe, potentially, on the way down. Be ready for it. Just be prepared for it. Whatever it is that you want to do with that, just be prepared. That's all I'm telling you. That's it. The FTSE Emerging Market Index and the S&P 500. I thought it was interesting to see that the S&P 500 is destroying markets, other markets that is. The performance has been incredible because, why? Central banks printing money, broken record GPS. Yes. I'll just move on. Bridgewater has boosted its bearish bets against Italian companies to $3 billion and 18 firms up from $1.1 billion of shorts in October. They have just simply doubled down, tripling the amount. The investment firm's positions against European companies as a whole has totaled $3.3 billion, 20 names, the data has shown. We are talking about a massive company, all right? We're looking at $160 billion worth, and they're suggesting These companies in Italy are about to take a nosedive. I don't know what they're planning on here, because we can see that the ECB has been buying all the debt. They've been buying all these garbage bonds of these corporations. So what are they planning on doing here with all of this? I think it's betting against the central banks in this case. Now, if they have one or two major failures, this could cause a much more widespread problem, especially if it's one of the bigger boys. A lot of times what happens is it's one of the smaller lenders, the bigger one eats the other one up, the government comes in and they sort of, divvy it all up, and that's called a consolidation of wealth and power. It's done intentionally. And this ultimately allows more and more, let's say fewer and fewer institutions to control more and more. And of course, that means more power, right? So what we can see here is that there's no way that this can be saved without central banks printing up money, buying up debt, buying up shares, buying up ETFs, buying up all this garbage. The central banks now own everything, and it is very frightening because there's no transparency. We don't know what they're doing at any given time. We can never really tell. They can tell us some information. They can try to be supposedly transparent, at least some of their operations, but we don't really know what's happening. That's a fact. So we're at their mercy, and it's not safe for you and your investments and your family's future and everything else, that we are just simply victims to whatever it is that they decide today or tomorrow. Do they want to support the market tomorrow? Maybe not. Maybe everything falls and they are able to consolidate more power and wealth. Well, we'll see how it all turns out. I'll leave it there. If you found the video informative, then of course, please give me a thumbs up, because that helps to support the channel. If you're not already, you want to join the 84,000 plus people that are here at the Money GPS, 84,000 subscribers and counting. I want to hope that you will click that subscribe button and join the remainder of the people on here. If you are tuning in for the first time, you will notice very quickly that this channel is very different than the rest. So, if you found this video informative, I know you'll find my books, The Money GPS and my new release, Global Economic Collapse, even more informative. You can actually flip through these books. If you go over to Amazon, they have a look inside feature. It's going to allow you to flip through the pages of these books to see if you like them. Take care.